on closing remarks last week with Jeff Kilberg. Now, which day was that?
That was on Thursday of last week when we had the segment with Jeff, and it was actually very interesting, because he actually has a. We talked about a lot of different issues, but the adjustment in the sector rotation. So he also talked about some of the sectors that he's focusing on and some of the sectors that he's kind of taking a little bit off the table at this point in time, just because of some of the other opportunities that are out there. So when we really had our discussion, he was definitely talking about biopharmaceuticals as a industry that he's looking at financials, but he wasn't. He's really looking at what the interest rates are going to do in the near term, 3 months, 6 months before having an overall outlook of that marketplace. But then also looking at some of those the COVID stocks having
Mm-hmm.
still some abilities to have upward appreciation, maybe not going all in on those particular stocks, but still taking some positions on those on the upside because they still may have some potential. So we did talk about stocks like Zoom. We also talked about stocks such as Workday and things of that nature. So it was really interesting to see some of his perspectives of the on the overall market. And we actually had this discussion, I want to say before the jobs numbers on Friday. Yep.
Right.
We
I
had
was
this
going to
discussion
ask
before.
you, what was he thinking about the jobs number?
He was
Um,
cautiously optimistic. He was cautiously optimistic. I think he did reiterate though, if we saw a pretty decent jobs number, that it would give credence to seeing the market rally another 3 to 4% on the upside. I don't think that any of us would have called a jobs number like we did. I mean, it was 6% under estimates when it came to the unemployment rate. But he did say, if we see some pretty good, promising numbers, that we could see another upside move 3 to 4%. Obviously, we are seeing an upside move. I think we did actually see a three
mhm.
percent move, 2.5 to 3% move on Friday. We're seeing about a 1% move in the Dow today. So it seems like he is kind of right there on target at this point.
So on Friday, right now we're looking at the economic calendar. We're on schwab.com, and you can go back to what happened over the past couple of weeks. So we could see we have the we do have the unemployment rate listed here and the non-farm payrolls. And so the unemployment rate officially fell to 13.3% in May. And so it didn't increase because employers added 2.5 million new jobs. And now the thing is, at the bottom of this report, there is, from the Bureau of Labor Statistics, they collect all of the data. They did write a disclosure over a miscalculation error, because and this is actually the third month in a row they have this miscalculation error added on there. And the thing is, they did say that some workers might have been listed as employed not at work when they should have been classified as unemployed on temporary layoff. And so they feel that it's possible that the unemployment rate could have been as high as actually 16.1%. But it's still, even with that miscalculation error, it's still lower than, I mean, the market was expecting almost 20%. Briefing.com was expecting 21%. So to see actually 2.5 million jobs, but it's also telling us that maybe, that this PPP is working, this payment protection plan, it's getting a lot of maybe they're not working, but at least they're on the roll and they're getting their checks from the government. All right, so that definitely was a shocker, and it sent, like as you said, it sent the market a lot higher. And for the week, if we just go back and look at the S&P 500, now for the week, the S&P 500 was up 4.9%. And if you look at it year to date, let me draw where we closed. Let me just let me add a line, not a study. Let me click on draw. So I open the toolbox, click on draw, and let's just do that level here. And let me find the candle here. That's where we closed on the first day of this year, right there. And so we're just a wee bit off those levels, you know. I think it's like 0.5%. We're less than 1% off of where we started at the beginning of the year. Now, uh, now, what levels are you looking at? I know that, you know, over the past couple of weeks, we've been following the 10-day, but, you know, you know, we've been above that 3,000 psychological level for several days. So with Jeff, was he talking about any support or resistance levels?
He was still actually looking at the 3,100 level as the, well, there's two levels. The overall broad support level is going to be the 3,000 level. We still had that conversation to say that is a psychological level that our traders are going to be looking at. And he agreed. He says that that's going to be a very big focal point. So if we are able to stay within the range, or at least stay above the 3,000 level, that would be a good signal for the overall market. You could potentially see continued increases in the overall index. But he also did have another level there, a short-term level of 3,100 as the next level to be actually tested. And so if we are able to hold the 3,100, see a little bit of a bounce back up on the upside, that could give us a little bit more velocity to the upside. But if you see a pretty sharp downturn past the 3,100 level, say within just maybe one trading session, as you see, you know, a sell-off or maybe traders taking profits, we could see another test to that 3,000 level. So I think he's, like I said, he sounded like he was still optimistic. He's cautiously optimistic. He still thinks that the market can still move up on the upside, but he does also state that, you know, it's not going to be surprising if you do see a little bit of a sell-off for some profit taking at this point, because you're seeing a 30% to 38% move on the SPX from its lows. It just would be, it would make a lot, you know, make logical sense that you would see a little bit of profit taking from some of the big managers that are out there.
This is the fastest 50-day rally of this magnitude that we've ever had. So this is just you know, amazing. So that level that you're talking about, that 3,000 level, also corresponds with the blue line, which we have there. That's the 200 simple day moving average. Now, did you get to talk about the VIX?
We did, and it was actually a really good conversation. So we talked about the VIX, and obviously using it as a fear index type of indicator, and we really talked about the overall fundamentals of it. So if we are seeing typically in a marketplace, now today is going to be that outlier. We also talked about these outliers as well. But typically in the marketplace, when you see the Dow or you see the indexes go up, you typically will see the VIX go down. Reason being, you're not seeing these larger institutions, you're not seeing some of the larger investors that are out there utilizing, you know, out of the money, or utilizing put options really on the SPX to be able to hedge risk. You typically see people taking less risk, or not worried about hedging their positions when we have up days. Uh, and he was able to conceptualize that. We had that conversation, and we actually had a lot of comments into the segment about this as well, because a lot of traders are looking at the VIX in itself, and they're looking at the overall pullback. And we've actually talked to a couple of clients about this. They're looking at the overall pullback, and they're saying, hey, is there a possibility that the VIX can spike up from a technical standpoint if we're looking from a charting standpoint? And we kind of had that conversation of, it's nice to be able to look at a chart of the VIX, but you want to understand what the actual VIX is representing. So right now, obviously, if you looked at a chart like this, you would say, hey, you know, it was up at 80, it was up at 75, it could go up there again, and it rightfully could. But also understand that you're going to see these very quick spikes in the VIX when we see really heightened volatility within the overall broad markets in itself. 80% of the time that's not happening, right? You know, and 80% of the time we're seeing
They're
pretty calm
right,
markets, you know.
right. And also, you know, they are it's typically inversely related. You get more volatility when there's more fear of the downside. So if the markets are moving up, you typically have volatility moving down, and volatility overall has been moving down. That's the, you know, that's the general trend. But today it's up. And then people might say, well, why is it up? It's not always exactly in lockstep. Let's say about 90% of the time, and it depends on your time frame, but 90% of the time, um, they are inversely correlated. And today, they're not, and that's because there are people out there that they're hedging, they're looking for that protection by purchasing, let's say, puts in the overall S&P 500. And
And,
and
and Nina, too, for this week, it's not a surprise as well. We do have a Fed meeting coming up this week as
yes,
well.
excellent point. So what else is on the calendar this week? Let's go back to the calendar. So we'll fast forward. So we just talked about the jobs market. Now let's fast forward to this week. And we can see that the Fed, they have a 2-day meeting, and they're going to come out with their Fed rate decision on Wednesday. Now, no one's really expecting any changes from the Federal Reserve. So, traders and investors are expecting Fed Chairman Powell to keep these interest rates near zero. But what they're also looking for is, they want to know, uh, what the Federal Reserve is going to be doing with a lot of these new facilities that they've created to buy assets, how that's working, and also how this Main Street lending program is going to work that they've set up. And a lot of traders are starting to ask if, in fact, that the Federal Reserve is going to start um, actually trying to um, to control certain parts of the yield curve. And so some traders believe that the FOMC might start uh, maybe buying treasuries at maybe, let's say, the 10-year, and adopt some type of yield curve control, which a few other central banks have been doing, like Japan and Australia, because they're afraid that last week actually we saw the yield curve steepen, which is good news actually for the economy. That seems to show that there's a little bit more support and strength. People are more optimistic going forward, but actually it could be tough on investors uh, that are borrowing money. And if they're having a tough time, some of these companies that have to borrow at higher and higher rates, it could, become tough on them. So that will be interesting. So did you talk about the Fed with Jeff Kilberg last week?
We talked about it briefly. Really, the only thing that we were trying to discuss is how the Fed's going to be able to react if we do see a favorable job unemployment number, right? So right now, the market in itself, the equity market, is really looking 6 months to, maybe even 12 months out. So it's forward looking, and it's anticipating that the opening of the economy is going to be great. We should have a little bit of little headwinds, and we could potentially see new market highs. And I think that's what's priced into the marketplace right now. But how does the Fed be able to manage at least close to zero, or maybe a slightly above 0% interest rates, and not go into the negative interest rate market? Because we have seen markets like Japan that has been in stagflation, and they haven't really had any type of economic growth for the last 10 years, 10, 12 years. uh, how is the Fed going to be able to utilize the rate mechanism in a way that is not going to result in our economy looking like Japan? I think that's what his biggest concern was. But I mean, as of right now, he seemed like he was very optimistic as far as how the Fed was handling the overall economic crisis. And then also from the fiscal standpoint, I mean, the fiscal policies that we've had in place, not everybody's going to agree, but they were pretty swift and they were very broad based. And I wouldn't be surprised if we see another one that's a little bit more tactical. But overall, that was really what we were discussing when it came to the Fed. How do we stay away from the negative interest rate market? If we do have to go into negative rates, what are the other levers that are in place in order to make sure that it's effective. And we're not like a Japan or some of the other countries in the Eurozone that have, taken the same steps.
Now, so the Federal Reserve, they have that 2-day meeting. They'll have their decision on Wednesday. And we also have this week, we have continuing claims. Let's see, we've got consumer prices, producer prices, and consumer sentiment. I mean, everybody is watching those numbers. Now, the weekly jobless claims that are coming out on June 11th, that of course will be, crucial after we just, saw the May's unemployment report on Friday. Now, anything else you'd like to highlight for this coming week?
I think you really covered it. I'm actually going to be very interested in seeing the core CPI and the CPI data that is out there. I think the biggest fear that the Fed has right now is inflation. I think right now, if everything stayed the same, I think they're fairly comfortable in the actions that they've already taken. But if we see maybe a spike in inflation, a very rapid inflationary number that comes up, we might actually hear Powell discuss the contingencies for inflation going up. I'm really curious to see the CPI numbers because by the time Powell actually has his decision and the FOMC has their discussion, we'll actually already have those core CPI numbers that are out there. So I'm really curious to see how that is going to do, especially also when you're talking about just CPI in itself. That also includes food and energy, and we've seen the energy market just completely rally in the last month and a half to 2 months. The energy market in itself, when you're talking about crude oil, rose over 90 to 95% in the last 30 days. So it's going to be that big of a market movement does have an impact when it comes to consumer purchasing power, and that's really what we're going to be seeing when it comes to the core CPI data. And the CPI data is how is the consumer going to be able to how is the dollar, how is the consumer's money going to be able to purchase goods and services, especially in this environment.
All right, so let me show you what else is on the calendar, and then we'll come back to it. I'd like to just find out from our attendees, which particular stocks are they interested in taking a look at a little later. We'll talk about earnings and how the options marketplace acts before typically, and then what happens after the announcement, what happens to options prices. Now, Thor Industries, they came out before the market opened with earnings, and I was looking at it right before. It's up 10%. I was trying to get a fresh quote down here. It was up over 10% today, and what's really interesting is the options marketplace was pricing in for a 1 standard deviation move to be about a 10% move. So I'll talk about, how I got those numbers towards the end of today's session. So, and that's a stock that already came out with earnings. I thought maybe we could check to see, what stocks are coming out with earnings that maybe you're interested in. So here's Tuesday, before and after the close. After the close, there's GameStop. Actually, I used to trade that when I was on the floor. I believe they were just recently listed when I started trading them. Yeah, I believe so. And then on Wednesday, there's actually a couple, I should say on Thursday, there's a couple stocks that I'm actually more interested in because they're bigger names. For instance, Adobe's coming out Thursday after the close, and also Lululemon. They've been in the news for many years now, and it's a pretty actively traded stock. So any stocks that are coming out with earnings this week, are you interested in? And in a few minutes, I could pull up, when we get the tally vote, I could pull up one of those stocks. And Kevin, in the end, will break the tiebreaker. All right. Okay, great. Let's go back to, so that's the VIX. And you were talking about before we go back, talking about some other indexes. I just wanted to show you, you mentioned some virus stocks. And President Trump, they have their Operation Warp Speed. And they are trying to really accelerate and put the finalists that have a potential vaccine available out there on a fast track. And so the Trump administration, they're pledging to have a COVID-19 vaccine available in the next 2 to 3 quarters. That to me sounds quite astonishing. And right now there are 5 finalists for development, but there's actually about at least, there's hundreds of companies that are, have a therapeutic that they're working on or a vaccine. But right now there are 5 finalists, and one of them is mRNA, Moderna. Were you talking about Moderna with Jeff Kilberg last week?
We did. We talked about Moderna. We talked about Gilead Sciences, and we just said that there is going to be additional volatility in these stocks. What we typically have seen, and we could even see it in the Moderna chart here, is we'll have the initial announcement regarding a potential vaccine. Maybe have some preliminary trial results that have come out. The market overall buys up the stock, but we see that excitement fade away over time as things happen. So sometimes getting into these names, even post announcement for the results or what have you, could it could actually put you at a little bit of risk because a lot of the anticipation is being built up pre-announcement. And then also we had the discussion there as well regarding how the federal government is going to actually treat the vaccine in itself. So is it going to be completely free market, meaning is the companies like Moderna themselves going to be able to set their own prices and meet market demand on their own? Or will you see the United States government come in, or maybe even some other governments, agencies that come in and try to either set up either price points where they are not able to sell the product for higher than a certain price? Could you see also the United States government or what have you potentially take the patent itself and maybe distribute it to some other manufacturers as well to try to get it to the street as quick as possible? All of those actually do impact the companies themselves because it lowers their overall profit margin in themselves. So I think that's going to be the phase that everybody's going to be really looking at, is not only do we have a vaccine, but is the vaccine going to be readily available, and what does that look like when it comes to the companies trying to make a profit off of it?
So here's Moderna. Look at this chart. And then I type in Gilead. And what's interesting is the charts, I mean, they, they look somewhat, well, there's more volatility in Gilead right over here. Definitely. Every day during March and April, whenever there was news on Gilead, it could be a big S&P 500 actually market mover. Some other stocks that are in Operation Warp Speed here is AstraZeneca, AZN. Let's take a look at that chart. AstraZeneca. And then here's, you talked about Pfizer with me last week. So here's Pfizer. And there's 2 more stocks in there. It's Merck and Johnny John. So let's take a look at Johnson & Johnson. Here's Johnson & Johnson, looks similar to the other chart. And then lastly, Merck. I used to trade Merck. Let's take a look. Yeah, and so those are some of the stocks. Now, some stocks that aren't included just yet, but they are doing some work, would be like GlaxoSmithKline and Sanofi. So, and there's many people out there in the trials, in the that will take part in the phase 3 trials. So, Kevin, those people are quite courageous, you know, aren't
They
they?
are, but I mean, they're making some of them are making money for doing it, and there's people out there that's how they get paid. But it's very interesting when you brought up all of those charts. I would say probably the majority of those charts we had the same type of trends, right? We had the initial announcements, we saw a little bit of a spike, and you see a little bit of a sell-off. So I think that's really what Jeff was referring to. That
Mm-hmm.
maybe if you want to have exposure to COVID stocks, if you want to have exposure to Operation Warp Speed type of stocks, then maybe actually look at some ETFs, some healthcare ETFs that are out there. So we had the
Right
XL8.
here.
I'm sorry, I'm slipping it now.
Wait a minute. I have healthcare
XLV,
here.
I'm sorry, yeah, XLV. So the XLV we talked about. He also had another ETF that he brought up a little bit, something that wasn't I wasn't as familiar with, but he was just stating that you can still have some of the exposure to some of the vaccine stocks that are out there, but you have a diversified exposure. So if you do see some of the sell-offs in some of these names, just because of the overall volatility, you have a little bit of a cushion because it's a little bit more of a diversified portfolio instead of trying to pick out maybe one or two stocks and just riding those out. Because we've all seen biopharmaceutical stocks. I mean, we've seen trials that go good, and the phase 1 trial is great and the stock jumps 15-20%. Phase 2 trials are not as great, the stock sells off, right? So he's just saying, if you want to have that exposure, you can still have some upside exposure, but just look at maybe a diversified portfolio and utilizing ETFs in order to do that.
But look also, check to see if you're trading an ETF, check to see what the holdings are. At least
Mhm.
know the top 10 holdings. And you could do that on Street Smart Edge. Just right click, and then click on research. It will take you here. It will take you here and click on portfolio, and you can see what the top 10 are. And then, so look around. If there's like, let's say you really want to have it to have at least 5% or something be in Gilead. Well, this is not the one. It's, 10% in Johnny John, 5% in Merck. However, Pfizer and Merck are in that, so is Johnny John. They're in that Operation Warp Speed. But it's missing Moderna and AstraZeneca. So if you want those, then you'll have to, look around. So definitely check that out. All right. So let's take a look. And I'll just quickly show. I'll just quick. Now, did you talk about also the S&P 500? Did you focus on other indices or maybe small caps? Were you talking about the Russell last week?
Didn't talk about the Russell. We actually did focus a little bit on the NASDAQ and then the INDX. So the NASDAQ composite in itself, and then the INDX 100, which on Thursday, the INDX did hit all-time highs. I believe on
Mm-hmm.
Thursday, the NASDAQ didn't completely hit. I think it was shy a couple of points. But we did talk about those areas. Haven't really gotten into the Russell as of late, though. I haven't really
The
been talking.
Russell was really the mover and shaker last week. It was up 8%. The Russell was up quite a bit. And NASDAQ, like you were talking about, the work from home play, that's one of the reasons why the NASDAQ, let's look at the NDX, has been moving higher. And we could take a look at, see, we can go back. We can just take a look. There's 2 years there. Let me just show you. That's the all-time high that we have. And we broke through that, as you said, on Thursday. And I could zoom in a little bit. And then you could see year to date, how much we're up from the first trading day. I could just draw that level over here where we closed on the first trading day. And so we're up like on the year, it's like it's getting close to 10%. It's like 9-10% right now. So year to date. And the all-time highs, as you pointed out, are here. You could hover over the candle too. Let me exit the draw mode. And if you want to know what a date is for a particular candle, just hover over it. And in the upper left-hand corner, you'll get the date. And you can see that was from February 19th. And you can see where we closed on February 19th. We closed at 97.18. So we're what, 100 and more than 150 points above that particular level right now. All right. Okay. Do you have any other indices you wanted to talk about, or individual stocks?
No, I mean, we were looking at what I thought was interesting because it's actually happening today as well. When we were looking at the NDX and we're looking at the NASDAQ composite, we were still talking about that rotation factor happening. So we're still seeing a rotation in the marketplace. You're seeing the rotation going from the technology, healthcare, and the consumer staples, and now they're going more into the consumer discretionary. They're also going to industrials and then energy as well. What's interesting with the NASDAQ, especially the NDX 100, is that now some of the leaders in that index in itself have been some of the laggards for the last 2 to 3 months. For instance, he was really focusing on airline stocks, and if I don't say American Airlines, and if he's probably watching right now, if I didn't say American Airlines, he would say, Kevin, bring up American Airlines. Obviously, that's not a recommendation coming from Schwab, but he's a really big fan of American Airlines because of the overall move that it's had, and then also
They
the
came out with
outlook like
bad.
it
I
has.
mean, they just keep coming out with bad news. But I mean, layoffs. I guess
Yeah.
the costs that will. But didn't they announce like layoffs of? Let me get the numbers. Like 30,000 and
It's going to
cuts,
be
which is
interesting.
good for the company. But
Yeah, it's going to be interesting because they did have that while you're trying to find that. But they also had United Airlines and American Airlines had a little bit of a news blurb last week. I want to say it was around Tuesday of last week that they were in discussion with some of these unions that they deal with, and it sounded like they were actually on the verge of actually having some form of a deal that is out there, potentially having a deal, which is a really big deal because if not, they could be under some restrictions if they take money from the US government, right? Some of the bailout money, if they don't
mhm.
have certain protections in place for workers. So there is certain things that they're not fans of. So they did have a little bit of news that said, hey, it sounds like something might be going on. But also with American Airlines that happened on Thursday is they also announced that they're expanding their summertime travel routes. They're going to actually open up more travel, domestic travel, because they're seeing increased demand for it. And they're seeing demand a lot quicker than they would have thought. So that was actually the real mover for the stock on Thursday. And actually, I believe it was up like 30% or something,
For the
something
week,
crazy on Thursday.
it was up 77% on the week. So he
Right.
was a bull from, early on. So, but yeah, and so the airlines last week, American Airlines was up 77%. Spirit Airlines was up 75%. Here's another stock. Let me just type in Spirit Airlines is save. They were up 75%. JetBlue was up 36%. JBLU. And let's see, Delta. Delta was more of a laggard there, only up 36%. And Hawaiian Holdings. But the thing is, the traffic is still, half. It's picking up from where it was. They're really looking far ahead
Yeah.
because it's half of. And this week we're going to get traffic reports, I do believe. So we could see, what those metrics are. And we have FB is telling us, what is that, Alaska Airlines. And they're up, wow, they're up 18% today. So definitely, and some of the most actively traded ETFs, especially amongst millennials, that's like a report that came out, JETS, JETS. It seems like millennials were buying into this market, when some of those that were staying at home or working from home, it sounds like they were, trading some of these ETFs quite a bit and putting money into it because the net flows have been a lot higher previously. All right, well, super. Okay, so what I thought was we could take a look. Let's take a look at the earnings calendar once more. And I think we had a lot of people vote. We did have a lot of people vote. Everybody wants Adobe. Everybody wants Adobe. Let's take a look. Adobe is coming out Thursday after the close. And let me just do some research. Also, when you're looking up if you're going to trade a stock, you're going to trade options, just make sure that you know when earnings are. All right, we looked at the calendar just now, but just make sure you know. Let me log back in. Here we go. We're on Schwab. We're on Street Smart Edge. Click on schwab.com. Once you're there, it will take you to this particular page. Type in the stock symbol and then do your research. Check to see what the Schwab equity rating is. And then, but the thing is, the Schwab equity rating is more for 6 to 12 months. So, and it compares this stock to other stocks in its sector. So it's a B rating. But if you are selling, let's say you're selling puts or selling a put spread, well, you could potentially be assigned if the stock's below your put strike and you hold it through to expiration, or if it's in between the strikes, if you sold the put spread and you end up holding the stock, end up owning the stock. So, you have the short-term play, but if you end up holding the stock, maybe it turns into a longer term trade than you thought you would initially, especially if it turns into stock. So Kevin, has that ever happened to you where you thought you'd do a short-term play and it ends up being kind of something you carry for a couple weeks or months?
Yes, happening to me right now. But yes, it happens. But
Mm-hmm.
overall, when I look at those type of situations, my overall goal is to try to make a profit. That should be any trader's goal. So if you are in a position where, let's say it does go into your favor, but maybe it goes into your favor a little bit quicker than what you expected, and you have to readjust. I think if you're on the right side of the trade, I think that's a good problem to be able to have. But there could be some times where you're potentially in a position for a little bit longer than you expected. Just as long as you can have the discipline to call it, to be able to exit your position. If you have the discipline for that, I think that's the biggest key, because sometimes we could get stuck in a position for way too long and then we start rationalizing our reasoning for doing so. And I think that also is a little bit of a dangerous situation, right? I mean, we're all traders, so we've had that situation where we're like, oh, it's down 5%, I'll hold it for another 5%. If it goes down 10%, I'll sell, and then it goes down to 10%. Well, I'll go down 15%, then I'll sell. And we kind of had that snowball effect happening. So I just think discipline is definitely key, but it happens to every trader that's out there.
Mm-hmm. And so check to see what other analysts have to say. Morningstar, Credit Suisse, read through the reports, what bulls and bears have to say. And this is what we're going to talk about next. And you'll come across these news headlines. Check to see what, what the news is for a particular stock. Do your research. And then you'll come across these articles where they talk about straddle prices for the stock. And, you know, if you're wondering, why are they talking about straddle prices? Well, that's what we're going to do right now. Let's go to Street Smart Edge. Let's take a look. First, let's take a look at a chart. And I'm going to go back 2 years. I like, different traders do different things. I like to go back 2 years, check to see how the stock moved before and after earnings. What type of range of movement did it have? Now, if you go back too far, I have to say what happened 10 years ago, the marketplace was just a lot different than, where it is now. So, and because let's say Adobe, you know, I know them for that Adobe Acrobat PDF, but they have a lot of other stuff too. I mean, they focus on a lot of cloud-based things. They try to compete a lot with Microsoft's Office suite that they have, but they create a lot of software for use in the cloud. And so, that's a lot of different than where it was, let's say 10 years ago. So I like to go back 2 years. I don't like to just go back and pick out one earnings. Now, Kevin, what about you? How far back do you like to go?
I like to at least look at a minimum 4, but I'll go out to
Hmm.
typically 6 earnings plays just to be able to
Hmm.
get a feel for it. Because Nina, there's also different market factors that are in play as well, not only
Hmm.
just for the stock, but just the market in itself.
Hmm.
So certain things you want to make sure that they're not outliers. You can try to find a complete trend that is out there. So I typically go at least six reporting periods.
And that's the thing. And so I get a lot of questions like, well, you know, don't you care about the fundamentals? Well, sure, you absolutely you do. I mean, that will ultimately, a lot of what comes out after the earnings announcement will drive the price. Okay, but what we're going to talk about is how a professional trader will price the options because they're looking back in time and they're pricing for a range of movement up or down. They actually don't know where the markets are going to go. After earnings, they don't know. And another thing is they don't have actually an opinion. Now they might, but typically a lot of professional market makers, if they're making a market in the option, they try to stay relatively neutral. All right. Now they might be, you never know, they might end up being long a lot of stock, short a lot of stock, sure. Um, but when they're pricing options, the options are priced for a potential move in the stock up or down. So that's where we turn to volatility. Now, Kevin, I thought you could just define what volatility is and tell us what happens around earnings.
Sure. So when we're actually talking about implied volatility, what we are trying to imply is the market anticipation for the stock to move either direction, just like you were talking about. The market maker is trying to see if their stock is going to go up or if it's going to go down. They want to be able to price the options accordingly. When we see the implied volatility increase, you'll typically see that increase when we come up to earnings, like we will talk about for Adobe. But there could be also other things that are out there as well. If they have maybe a stockholders event, if they have a recent drug that they're getting trial results for, we might see implied volatility increase as well. And then you'll have the event. So let's say that Adobe, they'll have earnings on Thursday, they'll have the earnings, and then after the earnings, you'll typically see the implied volatility be sucked out of the marketplace. Basically, meaning the marketplace itself doesn't think the stock is going to move as much after the earnings as it did for the
Hmm.
earnings. And that's all because of anticipation. So that's really how we gauge implied volatility. We look at it as the expected move of a stock.
Now, in this case, volatility, the earnings event, and always put in the E flag so that you know when earnings were. And then you could see if earnings were, many, many weeks ago, you could be bumping into earnings. But in this case, you could see that actually volatility stayed elevated, and that's because the overall marketplace was moving south quickly. So that's why it stayed elevated. And so um, but you could see over time that did drop. But typically, you'll see these notches in the past where the volatility drops below. And right because we had such high volatility in March, that these drops in volatility after the announcement don't really look like much. Um, they they don't really look like much. That's because this volatility is just so high. Now, let's take a look. Let's go to my watch list and let's talk about the stocks that were coming out this week with earnings. We could see here's Adobe. Its volatility right now overall is 38. It's 80% of the time the volatility was lower than where it is now. That's what the IV percentile is. And you could add this information to your watch list. Not only what is the current implied volatility, but where has it been over the past year? And you could see that IV percentile as what percentage of the time. The IV rank, where is that again? It's over here, right? Let me add that information. Here, it's under the Greeks, under the Greek section towards the bottom. And then the IV rank shows us, based on where the volatility is now, based on where the volatility is now, um, where has where does it stand? How does it rank over the highest and lowest over the past year? And so the highest has been, it did, hit over 80 a few times. But the lowest has been $16.23. And right now that volatility is, let's say, 40. So it's a little in the lower half range. And that is what the IV rank is telling us for AMD. It's in the bottom third. It gives you that exact level. So it's in the bottom third. So it's high when you go back over the past year, but it's been a lot higher. But it's still actually pretty high when it comes to earnings. So we can anticipate that volatility will drop. So if you're buying options, that volatility is going to drop. So that means the time value in the options will be crushed. And then what you need is the move in the stock to be big enough to compensate for that volatility drop. So if you're buying calls and the stock does hustle higher, but not enough to cover that volatility drop, maybe you're close to your break even, or maybe you have a complete loss because the move just wasn't big enough, or the stock was in the complete wrong direction. So that's the risk that you do run if you're simply buying options. Now, if you're selling options into high volatility or higher volatility, well, you're looking to take advantage of that volatility crush, but you want to be right about your direction. You want the stock to sit where it is, or to at least, not really hustle in the wrong direction, because you are taking on risk. Now, let's go to the options chains. And with the stock trading close to so we do have a strike price. The 397.50 comes to being the closest strike price to where the stock is trading. And the straddle is worth about $22. So this is what traders look at. They look to see how the options marketplace is pricing in the potential range of movement. It's about a 1 standard deviation move. That's what they're pricing in right now. And when you take $22, divide by the stock price of, let's say, $397, that means the marketplace is pricing in for a 5.5% move. And keep in mind, today it moved 1%, but they're pricing in for a 5.5% move. Now, what kind of move has it had over the past 2 years? And that's the thing, I looked at just a couple stocks, and I looked at the past couple of years. I looked at the past couple of years, and the average move was around, let me get this. I wrote it down here. It was about over 6%. 6.5% was the average move. It wasn't just one time frame. It was the average move. Sometimes it was a little less, sometimes it was a little more. So right now they're slightly more complacent than where the average moves have been. So if you're looking to buy options, you have to pay attention to your break-even levels. Always pay attention to those break-even levels. Now, if you're doing the shorter dated option, you run out of time. So the volatility will drop significantly. And this straddle price is from now, the thing is, earnings are Thursday after the close. The straddle price is pricing in for a couple extra days. Well, it's pricing in also for this week, right? We have the potential for movement this week. So what you'll see is the straddle will decay, but volatility could start to increase a bit. So you might see these straddle levels stay the same, but you'll only have Friday. That's the only trading day after the announcement. So this straddle is really building in for about a $22 move. It could be 22 or less. It could be more, of course. Then it would be more than a 1 standard deviation move. All right, so pay attention. And I just wanted to point out, check to see what your break-even levels for your strategies always make sure you know what they are. And what is the probability of the stock going to that level? That's where you could turn to the deltas. Now, one interesting thing before we do close is Thor. They're that RV company. President Trump last week said he'd like to buy an RV and take Melania around the country. You know, maybe he's going to do that. But you could see that the stock is up over 10% today. And the straddle was pricing in, it was about a $10 straddle on Friday. So it's interesting that we actually ended up getting a move in that range. Now, what does the marketplace price in for? They're pricing in for an up or down move, okay, when you're looking at that at the money straddle. Now, Kevin, do you have some closing comments about looking at the straddle?
No, I think you really touched all of the points there when you were trying to look at the expected move. You look at the straddles. It is this one standard deviation. It's not going to be perfect, but it's a good rough estimate to see what the market's anticipating overall. And then, you know, if you're if you're looking at buying a straddle, maybe, you know, give us a call. We could probably talk about that strategy in itself and maybe some other strategies that are out there for earnings anticipation. If you want to do an earnings play, that might be a little bit more advantageous for you when it comes to ensuring that you're not buying too much extrinsic value and things of that nature. But overall, I think that you hit it on the head there.
And then you could see, just look at Thor. You know, they were pricing in for about a 10% move. We got more than that. And, you know, if you bought a straddle, you're like just breaking even.
Hmm.
You know, however, if you bought certain calls, but you could see, you know, what the previous close was. You know, if you bought the 110 call previously for 615, it's worth about, let's say, 1150. Now, what if you bought the 120 call? Well, you know, you paid, let's say, 80 cents, you could sell it for $2. But on Friday, this thing, if the stock's at the same price, it's going to be worthless. So if you typically get your pop on earnings, if you're running out of time, I typically shut it down, especially if it doesn't have that any intrinsic value, but it's gained value. I would shut it down. Oh, this is actually, this is the, let me look at, oh no, this is the only expiration available. But this one still has time. This one still has 12 days to go. But check to see, you can go to this example, see the previous close from Friday, how much these calls are worth. And then if you want to see the worst case scenario, that would be if you bought puts, because the stock moved higher and volatility dropped. So you could see people that paid, you know, for the 105 put, you know, $9, this put's worth, you know, like 250. So 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 you need the direction to happen. The more swiftly it happens, the better, and the stronger the move if you're buying options. If you're selling options, you don't want that particular uh, you know, move. You'd like the stock to sit still. All right. Okay, see. Let's see what questions we do have. All right. Let's see. We've got a question about puts. So if you have an upcoming ex-dividend date, a professional trader, if you're just, you know, looking at considering buying calls or buying stock, you prefer to, and let's say the dividend is going to increase, you would prefer to actually own the stock over owning the calls, because if the dividend starts to increase, the call values will start to go down and your put values will start to go up. Now, the thing is, as you're heading into that ex-dividend date, the the options pricing model, it does know that dividend is looming, and it starts to make adjustments as you know, weeks before, and you'll especially see it with the more in the money options, and they will start to adjust for that upcoming ex-dividend date. So you won't see that dramatic change that possibly you are looking for. Now, if there is a surprise increase in the dividend that catches, you know, traders. You could see in one fell swoop, you could see, you know, the put prices make a big change. Let's say there's a special dividend or something. And so when it comes to dividend, what type of help can the trade desk give, Kevin?
Yeah, we could talk about the overall risk when it comes to an upcoming dividend, and I think you really laid it out there pretty well. So if you're actually like if you are a short call holder, right, you could have the potential of being assigned early because there could be a time in the marketplace. Typically, it's going to be the day of or the day before, where potentially, like you said, most of the time the marketplace has it priced in. But if we see like a really big move, sometimes there is an arbitrage that is out there that some investors, some institutional investors could utilize where they're actually able to exercise their call option and receive the dividend, and that actually is worth more than the premium for the call. You don't really see a lot of movement, I would say, on the put side as much because this really is priced in, and then there's no incentive for somebody to exercise a put option before a dividend, typically, because then they would be then selling their shares, and typically you want to hold your shares up into the ex dividend date. But if you have any questions, they can give us a call. We'll put the number on the screen here. You can give us a call. We're willing to be able to answer any questions you may have. But the dividend and trying to own an option around a dividend or an ex-dividend date does get a little bit tricky. But after a while, you'll start getting used to it, and you'll be able to see how to manage that position. But Nina, last thing I'll probably say is if it sounds too good to be true, 99% of the time it is. And I notice that some new options traders think that they can find this arbitrage opportunity and then they'll execute a trade on that because of the dividend. And then they'll see that the option was already priced in for the dividend and they end up losing money on the premium. So just kind of uh, one of those things that happens with new options traders. We all go through it and we're here at the desk to be able to assist with that.
And then David in Oregon, that options move that I said, it was a range, but it doesn't mean it can't move more than that. Of course, we've seen stocks make big moves. That's just when you're looking at the straddle, it's an estimation of the range of movement, and it's a 1 standard deviation move. And it's not the absolute max. It can move a lot less than that, of course, but the market makers need you know, they need to start somewhere, so they look to the past. They make an estimate based on also volume that's going on in the marketplace, and they come up with a straddle, and you could start to apply it into your assumptions and pay attention to those break-even levels and your strike prices, because there could be movement after the announcement. All right, well, super. Once again, Kevin, I would like to thank you for joining me today on closing remarks. And I know you're going to be on multiple times this week. So we all look forward to hearing from you